Thank you, Augustine. Let me turn to the special chapter on the entry into financial services of large technology companies, the so-called big techs that have established platforms in their respective businesses, such as e-commerce, search, and social networking. It is still early days for big techs in the financial services, but given their size and customer reach, they have the potential to spark rapid change in the financial system. The chapter provides an initial assessment of the benefits and costs and maps out a number of questions that deserve further attention. I can summarize the broad findings as follows. First, big tech's access to customer data expands the scope for financial inclusion. And they do this by reducing the need for documentation and for collateral, both of which have traditionally excluded users from banking services. At the same time, big tech's entry into finance introduces new elements in the risk-benefit equation. Some are old issues in new settings, which can be addressed by adapting or expanding existing regulation. But there are also important new elements. Public policy towards big techs in finance needs to build on a more comprehensive approach that draws on financial regulation, competition policy, and data privacy regulation. But before we get there, let me give you a few highlights of the chapter. The business model of big techs rests on enabling direct interactions among a large number of users. And an essential byproduct of their business is the large stock of user data. The data are then used as inputs to offer a wide range of services that exploit natural network effects, generating further user activity. An increased user activity then completes the circle as it generates yet more data. We dub this the data network activities loop, or the DNA loop. And the important feature of the DNA loop is that it's self-reinforcing. More data generates stronger network effects, which elicit more activity, leading to yet more data. This means that big tech firms with an established platform have a running start when they venture into new services. The nature of their competitive advantage, of course, depends on their existing platform. Big techs in e-commerce collect data from the activities of sellers and buyers and can combine them with financial and consumer habit information. These can then be used for credit scoring models, especially for SME and consumer loans. Big techs with social media platforms have data on individuals and their preferences, as well as their network of connections. Big techs with search engines do not observe connections directly, but typically have a broad base of users and can infer their preferences from their online searches. Both in the case of social media and in search, the big tech can use the information on user preferences to market financial products or to serve as a supermarket for third-party financial services, such as insurance. All of these advantages can expand financial services to users who were previously excluded. Take the example of lending. Screening borrowers for creditworthiness is a costly activity for lenders. And many SMEs in developing economies often do not have audited financial statements, and borrowers who lack basic documentation or are in regions without bank branches get left out. But big techs are in their element in this kind of setting. They can tap relevant information from their existing platforms and overcome these informational problems. Let me take you through an example from the chapter, which illustrates the credit scoring algorithm used by Mercado Libre, which is a well-known e-commerce platform that operates in Latin America. Imagine that you use a black box to screen good borrowers from bad. The black box, as you can see, has a green light and a red light. You feed in the name of the borrower, and either the green light comes on, and you say yes, or the red light comes on, and you say no. Now, to evaluate the accuracy of the black box, you could compare the signals to the final outcome. So in this graph, the vertical axis measures the proportion of good borrowers that receive a green light. And the horizontal axis measures the proportion of bad borrowers who nonetheless receive the green light. And suppose that you can dial up and down the frequency of the green light. Then in that case, if the black box is just noise, good and bad borrowers are treated equally, and there is no information value to the signal. And this case is given by the 45-degree line. Now, ideally, good borrowers should get the green light, and all bad borrowers should get the red light. And that's given by this dashed green line. And in general, the higher is the curve above the 45-degree line, the better is the credit scoring model. So on this slide, the yellow line is the outcome using standard credit bureau ratings and borrower characteristics. As you can see, the performance is certainly better than the black box, which is just noise. But compare this to the blue line. The blue line uses the Mercado Libre machine learning model based on all the data from the e-commerce platform. And you can see that the blue line is higher than the yellow line, indicating that big data from the e-commerce platform allows more effective screening of bad risks than standard credit assessment methods. And this is perhaps not so surprising, as the data from the e-commerce platform tells us not only about the borrower, but also on how the borrower interacts with the rest of the online community on the e-commerce platform. You know the borrower's activity, but also the activities of all the business counterparties. So this is just like judging someone's character from being able to see the character of all his friends. As well as the cost of screening borrowers, another impediment to credit is the cost of monitoring and enforcement of loans. Banks usually require borrowers to pledge collateral to deal with the risk of default. But big techs can address issues of monitoring and enforcement rather differently. For example, it may be relatively easy for a big tech to deduct payments from revenues that flows through its payment account. Also, if the big tech is dominant, then the threat of a downgrade or an exclusion from the ecosystem could be a powerful sanction against the borrower. This could explain why, unlike banks, big tech's supply of corporate loans does not correlate with asset prices much. And this is an illustration of that. So this chart reports the results of some empirical work that's currently underway here at the BIS, using some very detailed data from a big tech lender in China. It shows the estimated elasticity of credit with respect to house prices in China. If credit is dependent on collateral, we would expect credit to be sensitive to house prices. And indeed, for bank credit, this is exactly what we see. And this is the left-hand column, which is the elasticity of credit with respect to house prices, and the coefficient is large and highly statistically significant. In contrast, when we conduct the same exercise for the credit issued by the big tech lender, the coefficient is much smaller. This is the right-hand column, and is no longer statistically significant. In other words, the credit from this big tech lender seems far less sensitive to the housing market than the credit decisions by banks. So far, I have talked about the many benefits of big techs, but there are also clearly costs. Let me turn to those now and say how policy might respond. Part of the costs are old issues in financial regulation in new settings. If so, the response calls for adapting the regulations to the new setting. If structural change has outrun the existing regulations, a revamp of those regulations will be necessary. The general guide is to follow the risk-based principle and adapt the regulatory toolkit in a proportionate way. A good example is the payment system, where big techs have become systemically relevant institutions in some countries. In China, big tech's role as payment firms is mirrored by their role in money market fund products, where users park their payment balances. And in turn, these money market funds invest in unsecured bank deposits, as seen in this slide. So the pink bars here are bank deposits. Over half of the assets are in bank deposits and in interbank loans. And although I don't show you the maturity here, much of it is of maturity less than 30 days. And this introduces linkages between big techs and the banking system. And large redemption shocks could transmit to the banking system through deposit withdrawals. To address these risks, the authorities in China have introduced a number of new rules, including rules requiring clearing on a common public platform for all payment firms, as well as a cap on instant redemptions. And we have a box in the special chapter. But big techs introduce new elements that go well beyond traditional financial regulation. The DNA loop, which lies behind the benefits of big techs, is also the very element that brings costs associated with market power and with data privacy. Once a captive ecosystem is established, potential competitors have little scope to build rival platforms that can mount an effective challenge to the incumbents. Dominant platforms can consolidate their positions by raising entry barriers or by positioning their platforms as bottlenecks for a host of services which could favor their own products at the disadvantage of other providers. Other practices, such as product bundling or cross-subsidization, could further reduce competition. These are issues that are more familiar to competition authorities and to economists working on industrial organization rather than to financial regulators. To navigate the new uncharted waters, the special chapter outlines a new, what we call a new regulatory compass, which organizes policy tools along two dimensions. One dimension of the compass spans the range of choices over how much a new entry of big techs into finance is encouraged or permitted, ranging from an approach that encourages new entry, that's north, to the one that restricts new entry. The second dimension in the compass spans choices over how data are treated in the regulatory approach. It ranges from a decentralized approach that endows property rights over data to customers, that's to the east, to a more restrictive approach that places walls and limits on the use of data, and that's to the west. The regulatory compass reflects the menu of policy choices and not the outcomes as measured against the ultimate goals. And the evaluation of the policy choices according to their effectiveness in achieving the ultimate objectives will need to take account of the potential interactions between the objectives of financial stability, competition, and data privacy. Take the example of the interplay between competition objectives and financial stability objectives. Traditionally, policy towards entry into the banking industry has been influenced by two divergent schools of thought. One view is that entry of new firms in the banking industry is a good thing, as it fosters competition. The other view is that a concentrated banking sector is better for financial stability, as incumbents are more profitable and thus are more able to accumulate a strong equity base and also have a higher franchise value, and so more likely to act prudently. However, the relationship between entry and effective competition is far from obvious when the DNA feedback loop is taken into account. Unrestricted entry may not increase effective competition if big techs manage to entrench their market power through control of key digital platforms, or when such control may generate the kind of bottlenecks described above. For these reasons, the rule of thumb that encouraging new entry is conducive to greater competition may be turned on its head. A second important dimension has to do with data. One way to approach the problem is the decentralized or Coasian approach that assigns property rights over data to the customers themselves, and the customers could then decide which providers they choose to share the data with. However, the DNA feedback loop challenges a smooth application of the Coasian approach. Big techs can obtain additional data from their own ecosystems that are outside the market in question. And since data have increasing returns to scope and scale, big techs will be able to make far more effective use of any incremental data. For these reasons, the competitive playing field may be leveled out more effectively by placing well-designed limits on the use of data. And let me illustrate this with a couple of examples. One example is the various forms of open banking regulations that have been adopted around the world. And a second example is the European Union's General Data Protection Regulation, or GDPR. Open banking gives authorized third-party financial service providers direct access to bank customer data. They also set common technical standards for application programming interfaces, or APIs. Now, to the extent that they entail the transfer of data ownership from big techs to customers, both regulations can be seen as measures intended to facilitate greater effective market competition through new entry and through a decentralized approach to data. For this reason, they're positioned in the northeast quadrant of the regulatory compass. At the same time, some parts of the same regulations limit the scope of data sharing. Regulators that limit the use of data are positioned generally on the western half of the compass. Open banking regulations selectively restrict the range of data that can be transmitted, for instance, to financial transactions only. There are also restrictions on who can access the data, for instance, to accredited deposit-taking institutions. Similarly, GDPR requires customers' active consent before a firm can use their personal data. Both types of restrictions can be seen as barriers to big tech's entry into finance through restrictions on the use of data. And for this reason, they're positioned in the southwest quadrant of the compass. Now, at first sight, having elements of the rules that appear in opposite quadrants may seem perverse. But given the special nature of the big tech DNA loop, the apparently contradictory approach may, in fact, result in the fostering of more effective competition. In some ways, these additional restrictions could have the effect of sprinkling grains of sand into the excessively well-oiled wheels of the DNA feedback loop. And in so doing, it may lead to more effective competition and a more level playing field. There is a whole host of other rules that can be positioned on the compass, and in the special chapter, we describe what they are and how they address the issues in the entry data nexus. We think that the regulatory compass is a useful device to classify the range of policy initiatives. However, it remains to be seen how far these policy initiatives will lead to the desired outcomes in terms of effective competition, efficiency, and soundness of the financial system. And the broadening of perspectives will be essential to make considered policy choices in this area. And given the many new challenges, the public policy approach will need to be joined up. First, there is a need for closer cooperation between national authorities, between competition authorities, financial regulators, and data protection authorities. These public authorities are represented in this compass by the different colors. So the blue are financial regulators, green, competition authorities, and the red are the data protection authorities. And currently, their mandates and approaches are not always compatible with each other. Second, as the digital economy expands across borders, there is a need for international cooperation on rules and standards. Innovation is here to stay, and much of it will bring great benefits. With those benefits clearly in sight, some degree of disruption and structural change of the financial system should not only be tolerated, but should be welcomed. However, disruption for disruption's sake should be greeted with greater caution. And more than ever, clear thinking is going to be essential to reap the benefits of financial inclusion and efficiency while mitigating the risks. Thank you.